$4.74. That is the gap. Right now, as Western traders are sitting at their desks watching a dollar index and a treasury yield, buyers in Shanghai are paying $4.74 more per ounce for the exact same metal. Not a different grade, not a different contract. The same silver, and that gap did not appear overnight. It has been building quietly, while most of the commentary in this space has been focused entirely on the paper market in New York. Today we are going to pull that gap apart completely, where it came from, what it means, and honestly, what it does not mean, because there are two very different stories you can tell about a spread like this, and you deserve to hear both of them. Stick with me for the next 20 minutes, because around the 12-minute mark we are going to get into something in the COMEX data that genuinely reframes the entire East-West picture, and it is not the number most people are talking about. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where allocation decisions get made at the institutional level. I have watched what happens when retail investors are handed a headline without the context behind it. That is exactly why this channel exists, to give you the same quality of analysis the institutions are working with, built entirely from publicly available data, with every source named as we go. If that kind of calm, evidence-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, today is a good day to fix that, because what we are covering is part of a bigger picture we are building week by week. Here is what you are going to take away from today specifically. First, a clear explanation of why the Shanghai premium exists and what historically drives spreads of this size. Second, an honest look at whether the Western market is genuinely lagging or whether the Shanghai figure is being distorted by local factors. And third, a framework for thinking about what a repricing actually looks like in practice, because it rarely happens the way the headlines suggest it will. Everything I show you today comes from publicly available sources, and I will name every one as we go. Before any of that, last week I told you to watch one specific level. I said if COMEX registered silver inventory broke below a threshold that the CME warehouse report had been quietly approaching, it would signal that the physical tightness narrative was moving from story to data. Here is where that stands right now. The inventory situation has continued to deteriorate on a trend basis. It has not broken dramatically in a single session. These things rarely do, but the directional pressure I flagged is still intact and still worth watching. I am going to come back to this in the 3 lanes section with a specific updated figure. Now the $4.74 gap. Silver is currently sitting at $73.11 on COMEX. On the Shanghai Futures Exchange, the equivalent contract is pricing at $77.85. That is a 6.48% spread between the two largest futures markets in the world for the same underlying metal. Now, before you react to that number, and I know some of you already have a reaction forming, let me give you the context that most of the commentary skips, because skipping it is how you end up making a decision based on half a picture. Drop a comment right now. I want to know something specific. Are you seeing elevated premiums at your local coin dealer this week, or has the retail premium over spot normalized in your area? Whether you are in the US, the UK, or anywhere else, drop it below. The comment section here becomes a real-time sentiment tracker, and I read every single one, so that data genuinely feeds into how I read these markets week to week. Here is the first thing to understand about the Shanghai premium. A price gap between Eastern and Western markets is not automatically a signal that the West is wrong and the East is right. Markets can diverge for reasons that have nothing to do with pure physical scarcity. Local tax treatment, import tariffs, financing costs, domestic demand cycles, and currency dynamics all influence how a futures price sits relative to its international equivalent. The Shanghai premium needs to be disaggregated before you can use it as a signal. Now, having said that, here is what the Silver Institute flagged in their most recent demand data that gives the Shanghai number genuine weight. Industrial consumption in China has been running at levels that are not easily explained away by paper market mechanics alone. When I pulled up their latest figures, the direction of physical offtake from Chinese industry is not a short-term blip. It reflects a structural shift in how silver is being consumed at the manufacturing level: solar, electronics, industrial connectors. That is real demand pulling on real metal, and that is meaningfully different from a speculative premium. Think of it this way: if you have 2 grocery stores in 2 different cities selling the same tin of soup and one store consistently charges more, your first instinct is right to ask why. Maybe it is local taxes. Maybe it is transportation costs, but if that store keeps selling out while the other one has full shelves, the price gap starts telling you something different. That is the distinction we are trying to make here. Is Shanghai charging more because of market structure or because the shelves are genuinely emptier? Here is where it gets complicated, and I want to be straight with you about this. The COMEX data is not clean either. When I looked at registered inventory figures from the CME warehouse report, and this is the number that actually stopped me when I pulled it up this week, the registered category, which is the metal that is actually available for delivery against futures contracts, has been under sustained pressure. The CFTC commitment of traders data, which gives us a window into how professional money is positioned in the futures market, shows that managed money, the hedge funds, the systematic traders have been reducing net long exposure. Now that sounds bearish on the surface, but here is the part that requires context. When managed money reduces futures longs while physical withdrawal data is moving in the opposite direction, you have a divergence between paper sentiment and physical behavior. That divergence is worth paying attention to. In 15 years watching commodity markets, the times I have seen that specific combination funds cutting paper exposure while physical offtake holds or increases have not always resolved in a predictable direction. But they have consistently been periods of elevated volatility, not always immediately, not on a schedule, but the tension builds and eventually one side of that divergence gives way. The question is always which side, and that is the question I genuinely cannot answer for you today, and anyone who tells you they can is selling something. Now the macro layer, the article references the DXY sitting around 105.5 and the 10-year Treasury yield at 4.36%. Here is what those two numbers mean in plain English for someone holding silver at home. A dollar index above 105 means the dollar is strong relative to a basket of major currencies. That is historically a headwind for dollar-denominated commodities because a stronger dollar makes silver more expensive in foreign currency terms, which can suppress demand from buyers outside the US. The 4.36% yield matters because it represents the return available on what is considered a risk-free asset. When you can earn 4.36% in treasuries with essentially zero credit risk, the opportunity cost of holding silver which pays nothing is not trivial. Here is the honest truth that I want to make sure lands clearly. The macro environment as it's right now is not obviously bullish for silver on a short-term paper market basis. What the article calls a sticky inflation environment, U.S. inflation refusing to drop below 3.1% according to the Bureau of Labor Statistics, does make a theoretical case for hard money. But theory and market timing are two different things, and conflating them has cost investors real money. If someone in Manchester is watching their SIP allocation to silver and feeling pressure to act based on the Shanghai premium headline alone, I want them to hear this clearly: the fundamental picture and the timing picture are not the same picture. The counterparty risk angle in the article is one I want to address directly because it is real, but it is also frequently overstated. The piece references institutional money moving toward allocated silver to avoid counterparty risk in the futures market. Let me give you the unvarnished version of what that means: unallocated silver, which is what most retail investors hold through ETFs and futures-backed products, means the metal backing your position is not sitting in a vault with your name on it. It is pooled. In normal market conditions, that distinction is largely academic. In a genuine stress event, a default, a liquidity freeze, a run on the warehouse, it becomes very real very fast. Allocated silver costs more to store, it is less liquid on a day-to-day basis, and for most retail investors, the practical difference in normal conditions is minimal, but the direction of institutional movement is worth noting. When the people who manage institutional scale positions start shifting toward allocated even gradually, it is not a coincidence. Think of it like a building with a smoke alarm that keeps going off briefly and then stopping. Most people ignore it after the third time. The facilities manager who actually knows the building starts checking the wiring. The institution's checking the wiring is worth knowing about. It does not tell you the building is on fire. It tells you someone with more information than you is taking the signal seriously. The industrial demand picture underneath all of this is the part of the silver story that I think gets the least coherent treatment in most commentary. Silver is not like oil where you can watch it being burned in an engine. It disappears into products: solar panels, semiconductors, medical devices, electrical connectors. The Silver Institute's data on solar-related silver consumption is directionally clear, even if the precise ounces per megawatt figures vary by panel technology and manufacturer. I am not going to give you a specific number per megawatt here because that would be false precision and you deserve better than that. What I can tell you is that the scale of solar deployment globally and the UK's North Sea energy transition is part of this picture, not separate from it, represents a structural floor under industrial silver demand that was not present 10 years ago. That floor does not guarantee a price level. It does not prevent short-term crashes. But it changes the nature of the recovery when those crashes happen. Alright, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. The paper market lane, what I track in blue, is showing managed money reducing net long exposure. In silver futures, according to the most recent CFTC commitment of traders report, COMEX registered inventory remains under directional pressure based on the CME warehouse data. Margin dynamics are not showing a dramatic spike, no emergency changes from the CME this week, but the futures market structure is not one that screams aggressive institutional accumulation right now. That is the paper lane. The physical lane, silver, is where the Shanghai premium lives, $4.74 per ounce, 6.48%. The LBMA Vault data and Royal Mint sales figures for the UK market give us a Western physical red, and what I am watching there is whether retail premium normalization, which had been happening, starts to reverse. If you dropped a comment earlier about what you are seeing at your local dealer, I want that data. The physical lane is where the article's thesis lives or dies, and anecdotal dealer-level data from this community is genuinely useful signal. The macro lane gold is pointing at a real tension. The dollar is strong, yields are elevated, and yet gold has not collapsed the way the textbook would predict. When gold holds relatively firm against a strong dollar and high real yields, it is usually telling you something about global reserve demand that the headline numbers are not capturing, the World Gold Council's central bank. Buying data has been documenting a multi-year structural shift in reserve allocation that does not turn on a monthly basis. In 15 years watching currency and commodity markets, the times I have seen all three lanes pointing in the same direction even briefly have historically been some of the most significant turning points I have observed. I am not saying we are there today. The paper lane and the macro lane are not singing from the same hymn sheet right now, but the physical lane is doing something the other two cannot fully explain. That gap between what the paper market is doing and what physical buyers in Shanghai are willing to pay is the thing I am watching most carefully this week. Here is my one specific call for this week. I am watching the spread between COMEX and Shanghai silver, not just the number, the direction. If that $4.74 gap narrows because COMEX moves up toward Shanghai rather than Shanghai falling back toward COMEX, that is a qualitatively different signal than the spread simply compressing. The specific thing I want to see is whether Western futures pricing begins to close the gap on a sustained basis across 3 consecutive sessions, not a single day spike. The data point to watch is the daily COMEX settlement versus the Shanghai close. If the gap is still this wide or wider by midweek without a corresponding move higher in Western prices, it tells me the arbitrage mechanism is not functioning normally, and that is worth a dedicated video on its own. This is my one call for the week. John FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. If those 3 things develop in sequence, the article's 6% catch-up scenario is not unreasonable math. The cautious picture requires only one thing to develop. A broader liquidity event, the kind of flash crash the article itself acknowledges, forces risk assets lower across the board, silver follows, and the physical floor takes longer to reassert itself than anyone's patience budget allows. In 2020, silver fell over 30% in 2 weeks before recovering violently. The physical fundamentals did not change during that crash. Liquidity did. Both of those pictures are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the 2 questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things, and I genuinely want your answers, not just a thumbs up. First, are you currently holding allocated or unallocated silver, and has the counterparty risk conversation changed how you think about that in the last 12 months? Second, based on what we covered today, do you think the Shanghai premium is primarily a physical scarcity signal or a market structure distortion? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe, because next week we are going into the mechanics of how East-West arbitrage actually works in commodity markets, and I will show you exactly how to read the signals that tell you when it is functioning and when it is breaking down. That is a skill worth having. And if someone in your life is watching their silver stack right now and feeling confused about what this East-West story actually means for them, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.